Right. Good morning, everyone. And it's a great pleasure for me to be a part of this distinguished panel this morning. There have been very many great discussions yesterday and today, and we hope with this distinguished panel to add and sort of enrich the discussion. Now, like many of you in the room, I have been to a number of these sorts of events, and very good ideas come out of these events. But also at these events, there's a lot of comparison, and particularly when the event is about Africa. Africa is compared to Latin America, Africa is compared to Asia, Africa is indeed sometimes compared to many Western countries. But I learned something about comparisons from my then 12-year-old son, who is 14 now, when he wasn't doing very well in school, and my mother and his mother and I were concerned, and we had a chat about it, and we said, look, Howie, your grades are not very good, and you're not doing well. And at the time, he had a very good friend of his called Thomas. Thomas was his best friend, and Thomas was doing particularly well in school. And he said, well, I'm trying, I'm doing my best. I said, well, why can't you be like Thomas? Thomas seems to be doing, quite well. He's your friend. You guys spend a lot of time together. And, he quickly came back without thinking a bit. He says, well, Thomas has very clever parents. So be careful when you compare people. Put things in context. And I hope that we will not fall into that trap. But anyway, welcome to this panel on deepening Africa's capital markets. Things have been talked about today about how good things are on the financial side for Africa, and rightly so. FDI at historic highs. We just had a session here about private equity. Again, historic opportunities. We even have PE now interested in infrastructure, which is just such a great thing for Africa. But the truth is that Africa, access to finance and capital formation remains a key challenge to growth in many countries in Africa. And the challenge is faced both in public and the private sectors. And I'll just give you an example that kind of straddles both. The African Development Bank estimates that over the next 30 years to 2040 or around there, Africa is going to need about $360 billion in infrastructure, and these are for already identified projects under NEPAD's PIDA. These projects have already been identified and costed, so these are needed in order for Africa to sustain this growth and to remove itself out of poverty. $360 billion, of which the bank estimates governments today and donor development cooperation partners can only fund about $100 billion, all right? Or about 30%, just under 30% of that. So where is the 70% going to come from? And the answer is the private sector. Is Africa geared up to raise that level of capital over the next 30 years? The challenges are many. Although there is a vibrant stock market in many countries in Africa, I think there is 23 stock markets across the continent, some vibrant, some less so. But that means that of the 54 countries in Africa, the majority have nothing. There is no activity from a stock market perspective. We also know that Africa's share of the global stock exchange activity is only 1%. So again, if you look at it from globally, although there are some pockets of success, in places where the stock market is working, you do find that Africa's share on a global perspective is still very, very small. Of course, some would look at that in terms of opportunity to grow, but what we're going to discuss today is what do we need to ensure that we can capture that opportunity. And the stock exchanges in Africa operate with almost no integration. They're all individuals, so if you want to really raise big capital in Africa from a stock exchange, that opportunity doesn't really exist. If you really want to get into really big numbers, that opportunity, it means you've got to go elsewhere to look for them. And some of those opportunities exist, and we'll be talking about them in due course. So I'm very pleased that today we have a very distinguished panel to talk about these matters. And before I introduce them, I just want to say one thing. There is no country or society in the world that has developed from agrarian to industrial without building financial infrastructure. Every time I go in my work with ICF to meet with governments, they're very happy to talk about physical infrastructure. They're very happy to talk about social infrastructure. These are things that voters like to hear. Voters like to hear that you're building a road, you're building a dam, that you're investing in education, you're investing in hospitals. They love to hear those things. But the minute you say, well, what about your financial infrastructure? What about your collateral registries, for example? You know, is a bank able to secure a title in this country for a loan? And then they get a little bit nervous. Then they get a little bit hesitant. And the truth is that there is very little discussion amongst the very people who should be talking about it on financial infrastructure. And I'm hoping that today this distinguished panel will help us to unearth some of the problems and some of the challenges with that. So I will invite immediately Mr. Jingdong Hua to come up and start. Mr. Jingdong is the Vice President and Treasurer of the International Finance Corporation. Jingdong.
Thank you, William. Good morning, ladies and gentlemen. Very delighted to be here. Thanks to the organizer for your kind invitation. So I'm here to speak as a practitioner on the role of capital market in Africa's growth story. And if there is one message I'd like to leave with you, that is, capital markets are not a luxury, it's a necessity. And I will expand on that a little bit, but let me first to bring a bit of a context. As you know, IFC is the largest private sector investor in emerging markets, and we are the only one to invest globally. So supporting private sector development in Africa is a priority for IFC. Last fiscal year, we invested a record $4.2 billion to help bridge the infrastructure gap, to promote a productive real sector, and encourage inclusive business approaches to help drive growth and job creation. We are also deeply involved in supporting capital market development in the region. IFC's Pan-Africa Domestic MTN program, or Medium-Term Note program, now includes 12 countries. We are working with government officials, regulators, and capital market practitioners in these countries to help put in place a framework that supports high-quality issuers. And we have ourselves, as a AAA international issuer, issued bonds in 5 African local capital markets. And in the past year and a half, we became the first non-residential issuer of local currency bonds in Nigeria, in Zambia, and the latest one in Rwanda. And the finance minister, Mr. Gatete, is here from Rwanda. We also offer structured and securitized products to help corporate tap capital market. And just last week, we announced our investment in the inaugural Euro-dollar bond issuance of 7 Energy, a Nigerian oil and gas company, which raised $400 million. And we provide local currency financing to help companies in Africa avoid currency risk when they need growth capital. So IFC is doing all of these because we believe capital markets are a necessity. They are essential to long-term growth, to recycle savings and channel funds towards priority areas such as infrastructure and SMEs, to protect economies from capital flow volatility, and to enable the private sector to thrive so it can create jobs and opportunities. And the good news is there is tremendous momentum for African capital market, and the momentum has held through the ebbs and flows in the global economy. We are seeing real money, investors' appetite for African capital market. Sub-Saharan African countries in 2013 raised a record $6.3 billion through hard currency sovereign debt. And year to date in 2014, the figure has reached a new peak of US dollar 6.9 billion, with Eurobond issues from Ghana, South Africa, Senegal, Kenya, Ivory Coast, and Zambia. And if you have read the press, there are a couple of other sovereigns who are planning to issue Euro-dollar bonds. This momentum creates an unprecedented opportunity to accelerate the region's economic and social development. And that is essential for African capital market to seize this momentum. Now, as William had just mentioned, some may say that African countries should focus on improving education and healthcare, or building roads and ports, and the social and physical infrastructure of their countries. But I want to argue that they also need to focus on the financial infrastructure in parallel. The financial infrastructure is often neglected. Results are not as tangible. But consider the development trajectory of countries like the United Kingdom. Domestic savings fueled growth because there was a system in place that efficiently recycled domestic savings and channeled them towards productive sector of the economy. While it is true that recent financial crisis masks the growth story of OECD countries, and also people think of the Asian crisis, the Argentine crisis, and these made big headlines, and financial markets were blamed for economic collapses. But over-reliance on foreign investment was a key problem, highlighting the importance of denominating an economy in its own currency. Consider that today, OECD countries have approximately $30 trillion in pension funds, and most of that is reinvested in OECD countries. Imagine a potential of having just 1% of that invested in Africa capital market in terms of the infrastructure financing gap. So what will it take to develop a vibrant capital market in sub-Saharan Africa? It will require domestic capital markets that offer transparency and predictability, that are efficient in connecting markets and savings, that respond to different investors' risk appetite, with regulations that welcome domestic and foreign issuers and investors. This is no small feat, but it can be done with the right commitment and leadership. And think of Singapore in this case. In 1965, when Singapore became independent, this was a country with social unrest, high unemployment, and other slim prospects. By the 1980s, Singapore's GDP was growing at an annual rate of 8% because the government made a strategic effort to build human capital and create a world-class market and regulatory framework. And we all know Singapore today is a financial center. Some African countries are already on this path, and IFC is strongly committed to supporting them along the way. It is true that African countries face a number of challenges, and some of these challenges are so grave that they detract the focus from capital market development. But capital markets are an important part of Africa's growth story, and they offer solutions to some of the challenges. So let me end where I began. Capital markets are not a luxury, they are a necessity. Now, earlier this morning, I had the honor of being invited to the London Stock Exchange to witness the market opening to celebrate UK Treasury's issuance, historic first issuance of Chinese yuan bond. And just a month ago, I myself had the honor of opening the London Stock Exchange to celebrate IFC's 5-year offshore Chinese yuan bond listed on the London Stock Exchange. We have Ibuken here from the London Stock Exchange. And I look forward to the day when IFC can issue a Nigerian Naira bond on the London Stock Exchange. Thank you very much.
Thank you. Thank you very much, Jing Dong. Miguel, please.
Very good. Well, good morning to everyone. Being a practitioner and covering Africa for Citi in the investment banking arena. I think what I would like to share now is basically what I would say the 5 key parameters under which investors will look into opportunities in Africa, and namely in equities, given that we are talking about capital markets here. And I would say the very first one is reputation. Every investor wants to be associated with a company that does the right things and does the things right. No one wants to be associated with a fantastic business opportunity that tomorrow will be in the news with a huge spill of oil or something like that. So reputation in terms of environment policies, in terms of health, in terms of safety, the way they conduct business with the local communities, that is extremely important. And I will give you an example that you will listen to later in the day, but I think is really the best example we can have. The second topic is governance, the governance package that the company can offer. No one needs to sell to investors the opportunity in Africa from an economic standpoint. But we need to ensure that the upside, the potential is properly shared, is properly communicated, and there is the right board of directors, the right number of non-executive directors, the right transparency, the right attitude. And that will be very, very high in the priorities, given namely some recent not so good examples. So that will be more and more important going forward. The third topic I would say is the management team and the track record. That goes without saying. It is true everywhere, but I think investors have a view, and I think they are right, that doing business in Africa is for certain environment, ecosystem, background reasons tougher. So you really need to have the right management team with the right understanding of how to operate on the ground. And that's very, very important. And it will be a huge test. If you get on a roadshow, you will be really tested on that. The fourth point, I think, is you really need to show that your business is sustainable. If we are talking about Europe or the US, people will assume sustainability as a given. When you're talking about Africa, you need to show that performance will be even better in the next 10 years than in the last 10 years. And in the last 10 years, however, you had very favorable economic conditions, low interest rates, very low levels of debt in most of the African countries, not necessarily true going into the next 10 years. And you had high commodity prices, which, not being the only reason, by no means it's an important reason. So you need to show that the business model you have is sustainable into the next 10 years. And the final topic that people will focus on, and is directly related with this conversation, is that they can play the game. They can get exposure to the economic potential through investing in a particular security. And that really needs a stock market, that really needs liquidity, and that's where governments can help. I think right now, obviously London, and we have the London Stock Exchange here, is a good way of doing that. But I think going forward, we will see more dual listings, London and Lagos, for example. And on that note, I would just say that if we want to see how things can be done properly, and I think you will hear later in the day from Seplat, and we have the chairman, Dr. Ojiako, here. I think there was a transformational transaction for African capital markets, because that really showed how Nigeria oil and gas onshore, which is a tough proposition to sell to investors. But if you show that you can do the right things at the right time, you can actually attract a lot of money. And that IPO, which was, again, a dual listing in London and Lagos, was actually $500 million. So it's a very sizable transaction. It's very difficult to get a $500 million transaction, just purely Africa-focused, done in the market. But if you get things right, the money will come. I think I'll stop here.
Thank you. Thank you very much, Miguel. Kayode?
Thank you. Good morning, ladies and gentlemen. And let me thank the organizers of this event for inviting me, and particularly for the quality of attendance. 5 years ago, I attended a similar conference like this on African debt market. I think 80% of the participants in the hall were from Africa. And when we were going back at the lounge, we said to ourselves, why do we need to come all the way from Accra and Lagos to London to come and speak to ourselves in London? But I'm happy it's the other way around. I think we have more of the offshore people. So that means we are getting there. Today, I'm going to talk to you very briefly for the time that I have. The first thing is just to give a quick overview of the markets. The capital markets in Africa, as we all know, very, very illiquid in many markets, relatively small, less developed as you would like to see in other markets, and with a lot of structural and regulatory bottlenecks. But a lot of efforts are being made by a lot of African governments, in particular in Nigeria, and I dare say that a lot of the African countries, our younger brothers, are following us in that direction. Monetary policy, investor education, increased in infrastructure spending, and so on and so forth. On stock exchanges, the debate is out whether or not we have enough. We'll talk about that also briefly and see whether or not it's really a question of number, or is it a question of addressing the question of the depth of the market. Perception is another thing that we need to look at. Generally speaking, we need to improve on the governance structures. We need to improve on adoption of global financial reporting standards, regulatory oversight, and of course, ensure that we have zero tolerance again for market infractions. In terms of integration, there is need for us to also think about that deeply. There must be the first wave of integration. We should be talking about integration in terms of the West African and East African and South African sub-regions, and maybe to the larger region. Now, in terms of the efforts made at increasing liquidity, there's been quite a lot. For instance, in West Africa, there's been the launch of the West African Capital Markets Initiative, which we believe strongly will help in that process of providing liquidity to the market. Of course, the fixed protocol, which was not in existence in most parts of Africa for many years. Of course, you guys here have been enjoying that for quite a number of years. But now, that has been introduced in Nigeria. I believe there's some attempt at doing that also in Ghana. And I think once that is done, that has been done in Ghana also. And as you get into more African markets, then the tendency will be to have better integration of the markets. If you look at liquidity also, you can use the trade that has gone on between Africa and some other economies as a proxy. If you look at what has happened between Africa and China, for instance, in the last 5 years, 6 years, there's been a huge growth in terms of trade between us in Africa and China. During lunch at Buckingham Palace yesterday, this was a topic that was debated, particularly looking at what has happened between Africa and China and what is happening between Africa and Europe. And my own advice will be that for those of us who are in the European market, it's time to go back to our traditional markets. Most African nations have historical ties to Europe, but I think people have sort of taken at their eyes off the ball. It's not too late, and I think it's time to go back to your traditional friends and try and do a lot of things together. Stock markets, that's another question we'd like to answer. Do we have enough? It seems to me from what we can see here, even in Africa, we have about 29, Williams sent 2023, and this is from Wikipedia. We have 29 stock exchanges and 11 commodity exchanges. Thinking about it, that's not really too far from what you have in North America, which is a much, much larger economy with 46 and 16 major commodity exchanges. So it's not really a question of number. Really, it has to do more with the quality. And quality you can measure easily from the depth of the market. And also, it has to do with the type of exchanges that we should be talking about. In Africa, 81% of our export revenues come from natural resources and agricultural commodities. So it makes a lot of sense, actually, if you need to have more numbers, to have those numbers in commodity exchanges in some countries that do not have and who are heavy exporters of commodities. In terms of depth, I think the most critical thing really is that we do not have adequate depth in terms of liquidity, in terms of types of securities, in terms of diversity of securities. If you look at Nigeria as an example, our capital market is just 12% of the GDP. If you compare that to Hong Kong, which is 422% of GDP, and compare that to the USA, 115% of GDP. So it's not just a matter of number, it's quality. That is also further reflected in the slide you're looking at, which is on the Nigerian case. In Nigeria, about 50% of market cap on the of our GDP is in the areas of agriculture, oil and gas, telecoms, and entertainment. On the other hand, just about 4% of those important sectors of the economy are represented on the Nigerian Stock Exchange in terms of market cap. So clearly, again, it's about the depth, it's about the number of instruments, it's about the quality of instruments, and that is what we need to focus on. The other thing I would like to briefly talk about is regional integration. Is it important to have it? Clearly it is. We believe we should, and this should be done in two phases. There's a West African experience which is ongoing at this moment, and I think if we're able to successfully implement the WACMIC experience, it will change our market. I believe the same thing should happen in East Africa, in South Africa. And then the second wave can come, which will then be looking at Africa as a region in itself. But importantly, there are some factors that we need to deal with. Currency integration, political will, and then, of course, market trust and confidence. That's a major issue between nations in Africa, and obviously that has to be driven from the political leadership. One other issue that is very important for our market is to attract private investment to our market, apart from the issues of market depth, macroeconomic issues, and country risk, are two important issues: transaction cycle and cost. In Nigeria, for instance, a typical bond issuance transaction will take about 27 weeks from start to delivery of the fund. In Brazil, that's 15 weeks. I'm sure it's much less in this market. On the other hand, also, you have the issues of cost. It will cost 8 basis points to issue a bond in Mexico. In Nigeria, it's 120 basis points. It's the same story with equities. And usually I'm using Nigeria because that's a market I'm very familiar with, but I can assure you that it's not so far. That same story is not so far from other African countries. So we need to look at that and find ways of ensuring that we improve on those things so as to attract the much needed investment to the capital markets. In summary, 4 things which I'd like to leave you with. We need to deepen the market through infrastructure, spending, financial inclusion, liberalization of trade and forex flows, and investor education. Another thing that's very important is regulatory oversight. I believe that some of the markets are leading the charge. Certainly, our own Aroma Hotel is leading that charge in Nigeria, and I believe we are beginning to see better regulation in other African markets. But there's still a lot to be done to ensure that you create the right environment and the right level of confidence. Then, of course, there must be political stability, security. I mean, everybody talks about Boko Haram issues in Nigeria, and it's clearly there. If you're an investor far, far remote in northern part of Canada, you may not really be, not too much about Nigeria. And everything you read about Nigeria, if it is on CNN, then the tendency will be that that is what will dominate your discussion. But we need to address that. Of course, fiscal discipline across the continent is also important. And then again, lastly, we must encourage regional integration. At lunch yesterday, that was another thing that came up. People found the market in Africa a little bit too small. Of course, as you integrate, then you have larger markets, and those of you that have all the deep pockets will be attracted to come to Nigeria. Thank you very much.
Thank you very much, Kayode. Ibukun, why don't you give us your thoughts? Oops.
Thank you, William. Ladies and gentlemen, good morning to you. And frankly, I have nothing left to say, actually. Jingdong has mentioned the market open this morning. That was my piece of news to tell the entire audience about the renminbi bond. And Miguel has mentioned the Seplat transaction, which was going to be my next accolade that we were going to talk about. And of course, strengthening and deepening the markets. That was the third thing on my list, Kayode, so thank you very much. But hopefully there's a couple more things to mention, but I just want to say that we are very, very privileged at the London Stock Exchange to have such good partnerships with Africa in terms of the relationships that we have with the regulators, the issuers, and indeed the stock exchanges. And we're in a very, very privileged position. And we aim to try to keep that position of privilege. It's one that we have to work very hard to maintain because there are other exchanges who are also vying for helping African companies raise capital overseas. But we feel that we are very, very lucky. I feel very lucky working for the London Stock Exchange because apart from having such an illustrious series of panelists, I also get to meet people like the Chinese ambassador this morning. When there are various state visits, the Lord Mayor of the City of London has a banquet which he holds at the Guildhall, and we get invited to them. And the last one that had an African leader here was when Jacob Zuma was here, and I was able to invite my wife. It was a fabulous affair, white tie, men shined and bronzed and with regalia and all the things that the UK does very, very well. And I sat there and my wife had just had this exchange with Jacob Zuma and he was laughing after speaking to her and I thought, wow, this is great. There comes a time in a man's life when he needs to brandish both his wealth and status. And at this point I thought, well, I have no wealth, but I shall go to my wife and say to her, darling, did you ever believe in your wildest dreams that you would be shaking hands with Jacob Zuma as a result of my fantastic work? She looked at me and she said, darling, you don't feature in my wildest dreams. I've used up half of my time, so now we can get on to the rest of the business. But any ideas on who will be in my wife's wildest dreams would be most welcome later on. But just a very quick note on what's happening with global exchanges. Over the last 5 years, we've seen a real evolving environment for global exchanges. There has been extreme reduced revenue in terms of trading equities across global exchanges, with the result of certain regulations like MiFID. In particular in London, $60 trillion used to be the notional value of trading in London, with a shall we say, revenue value of about $60 million. That was all held by one exchange, the London Stock Exchange. Since then, that same revenue has come down to maybe about 40 million, and that's now shared by about 20 trading venues. So the revenue there is essentially what we say for the birds. So exchanges have had to change their models. They've had to adapt and develop. Again, increased regulations, for example, like Dodd-Frank from the US. We're seeing now more trading of CDOs and those types of exotic derivative contracts come online onto exchanges. And there's a larger number of asset classes now that are available based on the more dynamic financing requirements of the issuers that we serve. So whether that's through derivatives or ETPs, there has to be a change in the way that exchanges do business. Just as an example, the London Stock Exchange's business 5 years ago, about 90% of our revenues came from the trading of equity securities, the listing and trading of equity securities. Today that's down to less than 20%. And the biggest part of our business now is a business that serves the information requirement from financial markets. So trade reporting, sale of data products, and indeed the asset management community that uses the indexation parts of our businesses. So the challenge that faces African exchanges as we move forward is how do they begin to continue to evolve? Kayode talked of some very important things that are happening with the Nigerian Stock Exchange, also with Nairobi and the JSE, do they evolve to the traditional old models of stock exchanges, or do they start to develop newer types of interactions with their clients? Do they change their clients from the traditional European banks or African pension funds? And these are the questions that we need to all ask ourselves. What we feel, however, is extremely important is that we continue the interaction that we have with Africa. I mentioned at the beginning, London Stock Exchange is de facto the largest stock exchange outside of Africa for African listed equities. We have about 125 African companies capitalized at about $275 billion US. And in fact, since 2008, about $12.5 billion has been raised by African companies alone on the London Stock Exchange. So that is a very important position that we have. Now, the other element that we think is important for African exchanges is to be ready to be flexible to adapt to this changing world and this changing environment. And as an exchange that's actually listed on our own exchange, i.e. a corporatized, demutualized exchange, we feel that that sort of activity will be much, much easier as African exchanges become demutualized. And at this moment in time, only Kenya and JSE of the two are the only two African exchanges who've picked that particular route. The last couple of things I want to mention are just in terms of reform, in terms of the types of investors that are part of that makeup of African exchanges. There needs to be more reform to allow deeper penetration from pension funds and insurance funds. There needs to be a change in regulation to allow them to access the equity capital markets in a much, much more simplified manner. And equally, the establishment of retail participation in local markets, whether that be at the mutual fund level or indeed in direct participation. But I think the future is bright, and we believe that in partnership and collaboration, such as the ones that we've signed recently with the Casablanca Stock Exchange, to bring London's expert pool of capital towards Africa and to share in that growth together, we believe is the way forward. Ladies and gentlemen, thank you very much.
Thank you. Thank you very much, Ibukun. Let me just go into the questions now, and I'm going to start with you, Jingdong. Now, as Vice President and Treasurer for the International Finance Corporation, you obviously have a very global view of financial markets around the world. What can Africa do to get to the place that it needs to be to do the things that we've been talking about today? What is it based on your experience and view of some of the other countries and regions that you have seen?
Well, let me first say that I will not have a story as good as Jacob Zuma, but let me try. When I started working in China 31 years ago, I didn't know what a bond was. So fast forward to now, China has one of the most vibrant capital markets there is. Similarly, the broader Asia did not really focus on developing a domestic corporate bond market or supporting the regional integration of corporate bond market until the Asian financial crisis less than 2 decades ago. So on a macro view, if Asia could do it, I think Africa can do it. It's a matter of bringing together at the top level a government commitment in recognizing that capital market development is a necessity. It parallels the development of physical and social infrastructure. It is true that for most governments, they wanted to use social physical infrastructure to prioritize their spending. But at the same time, if you do have a market infrastructure, like Singapore, right? This is why you have Malaysian company, Korean company, Philippine company going to Singapore to issue their debt or do their IPO. Why? Because it has set up a regulatory framework, a legal system, an arbitration process that has a trust of the market, transparency, so on and so forth. So government's commitment in making sure there is a world-class regulatory framework is fundamental. The second level, I think several of my panelists had already alluded to, is that you need to have market infrastructure. Oftentimes, that would include the SEC that has to ensure that regulations and best practices are observed, right? So you don't want to have the SEC to be self-financing through fees, because then for a nascent small market, the fees would be too much to stymie people coming to the market. So I would view that supporting SEC, supporting national register or custodian clearance, all these market infrastructure as basic public goods. At least as an initial stage, you need to have national funding for this. Only when the market starts a virtuous cycle, then you can start to relax those and have market through its own fee generation to become self-sustaining. The third element I have to say is that although in Europe and in the United States, and for that matter in Japan, the QE has been quite challenging. But I think that interest rate differential between African countries and the advanced market serves as an attraction, right? I know because when we issued in Nigeria, in Zambia, in Rwanda, we do have foreign investors who really just tell us, why don't I just buy the whole thing? There is real appetite. Obviously, that 10%, 14% interest rate also help. But obviously, they have a fundamental a view on the market. They do their own risk analysis. But I want to say that that appetite, both for sovereign debt and for good quality corporate debt, are there. So I think we don't have a problem of not having enough risk appetite or investor interest in Africa. It is really connecting that through regulations, through transparent market practices, through a functioning infrastructure that bridge the two together. At the end of the day, I think the critical element for the private sector in Africa is that instead of borrowing nominally cheaper dollar, if your revenue is in local currency, you better borrow in local currency, because otherwise, that foreign exchange volatility is an element you don't want to introduce onto your balance sheet. So we always say, if your currency is local currency, I want to be able to, as a treasurer of IC, to be able to lend you in local currency so that you focus on growing your business instead of worrying about foreign exchange volatility. So all these elements.
Thank you. Thank you very much, Jingdong. We'll come back to you to explore this idea of the appetite for sovereign debt amongst African countries. Miguel, you are head of investment banking for Citigroup for Africa. We were talking this morning at breakfast, and you spend about 25, 30 weeks traveling in Africa, different countries. You have access in your role to the blue chip of blue chips companies that are trying to raise capital. What is their preference in terms of capital raising? And how are they going about it? What are you advising them, and what are they telling you?
Right, very good question. Because in fact, to have a capital market, you need demand, you need investors, but you also need companies to issue. And sometimes that's the toughest part. Because some of these companies have a view that they want to remain private. They don't want to really show their books, what they are doing, and that's fine. That's just an option. The reality is Africa in general is very long in growth opportunities. It provides an enormous amount of interesting growth opportunities, but it's short of capital. That's called the outside world. The rest of the world is short for growth opportunities, and is very long on capital. So if you bring these two worlds together, it should work. But to attract capital, and now I'm thinking more of equity rather than debt, you have to have the view that from day one, when you sell 1% of your company, it's not your company anymore. You are just the largest shareholder or the CEO. And sometimes this is, it's a very difficult step. But if you look it has been the same thing around the globe. And I think the best strategy to go about this is to really show the successful stories. And successful stories will bring more successful stories, and people will be able to share. Yes, it is a burden. It is tough to have all these quarterly reporting requirements to take questions from investors that sometimes are very silly questions, but you need to handle them graciously. So it's tough, but there's a reward, and the reward is you get capital, you get long-term capital to develop and to grab the opportunity. And I think that's where we are now. You need to have the capital at the right point in time so that you can grab. And it is very fortunate for someone like me to be touring the continent really these days and finding those entrepreneurs that want to become regional champions, that want to do acquisitions, and more importantly, want to invest more in different countries. So it is a very interesting time to be meeting these investors, and there's quite a lot of supply in the pipeline in terms of new IPOs coming out of Africa. And I think it's both west, east, southern, and north as well. Yeah. We sometimes forget about North Africa, but there's quite a bit happening there.
Yeah. Sorry, go ahead, Jingo.
Can I just interject a little bit, Miguel? I think it's terrific that you help the blue chip companies. My own observation is that in any market, the blue chip companies never have any difficulty getting financing, whether it's bank, capital market, because they are the best companies. The challenge is really to go to the next layer and the layer after. I remember 2 years ago, I was in Kigali, and I had a session with the private sector entrepreneurs. There was an SME owner who at that time said, look, my balance sheet, my performance was terrific, but banks just don't want to lend me money because, number one, I'm too small. So he said, how come that my performance is better than that of Greece, but Greece can still borrow cheaper than I did? So that was quite a enlightening statement for me. That is, for a country to be able to create jobs and provide financing, we have to dive down. Obviously blue chips are critical, but we need to dive down several layers to touch the SMEs.
Yeah.
Let me just react to this, because I fully agree with that. When we talk about blue chips, let's make sure that sometimes we're talking about one individual, but as a, aggressive, very solid team working with him. So that's one. On the other side, what we also see now is the local banking system being able to channel funds from international capital markets into the local economies.
Indeed.
And that's a very important role for the local banks, not necessarily for a global bank. So each of us has its own role, and I'm very happy to say that in the last 6 months, we helped banks in Nigeria raising $1.2 billion for businesses that are dollar-driven. So again, the right edge.
Thank you. Thank you very much. We'll come back to explore that issue a little bit more. Kayode, you talked very passionately about deepening capital markets, deepening stock exchanges. We're barely scratching the surface. What do you think is the challenge? Why is it that our stock exchanges remain so minuscule? Is it just a question of the size of the economies? What is preventing this?
Thank you. It's a combination of factors. The first one is obviously what you mentioned. The size of the economy is an important factor. That's why, for instance, the NSE would be a bigger economy than maybe one in some less endowed African countries, just as it's also a smaller capital markets compared to the South African capital market. So clearly, the size of the economy is important. But more importantly also is the phase of development of the markets. You know that the capital markets in these parts of the world have been there for as long as we can remember. But in most African countries, the capital markets are 40, maximum 50 years old. I think the Nigerian Stock Exchange started in 1960. So today that will make it 54 years old. And until the last 10 years, really, we were not quite a market that would be in the radar of the Western world. So again, that's a very important issue. The third very important issue is the level of technology. And obviously that's related to investment in that industry. I mean, we've talked about it earlier on that there's need to create infrastructure for markets to thrive. Until recently also, in most African markets, the infrastructure just was not there. I mean, it wasn't possible to have a fixed protocol when you didn't have broadband. Now it's coming to most markets, so we are beginning to do what will drive the market, and we, of course, will increase the level of transactions in the market. Another very important thing is the diversity. You don't mention that 31 years ago, you didn't know about bonds in China. I mean, I would say that it's the same story for many of us in Africa, in Nigeria. I mean, it wasn't a well-known industry. It wasn't a market that was for the rest of all of us. It was basically a market for a few elites. But now, because of technology, it is now becoming easier for people to trade without talking to a stockbroker. From some rural village, a teacher could place a trade on an online trading platform, and from the comfort of people's homes and comforts of their offices, they could trade retail. I think at least 10 or more Nigerian companies, Greenwich is one of them, already have online trading platform, which is commonplace in most Western markets. So that's another key issue, which is that investment needs to come into the industries that will ensure that we're able to create the technology and the platform to drive the trade. Of course, and very importantly, is also the quality of companies. Blue chips will always be blue chips. In Nigeria, you have the Nestle's, you have the Cadbury's. They will perpetually be there. But are they the ones that will need to grow the market to be able to catch up with South Africa, to be able to catch up with the rest of the world? Certainly not. We need to go to the next level. Right. And that next level usually will be local companies that have done pretty well, and some of them become eligible to go for listing. Even after that level, and there are not too many of them, and that will be true for most African markets. By the time you've looked at 5, 10 very, very strong family businesses, then you won't see too many that are also eligible for the first board. But as time goes on, we'll begin to have better quality in terms of instrument. Yeah. Again, diversity of instrument. Until recently, we didn't have ETFs in Nigeria, but now we have ETFs. We're going to have, again, all sorts of instruments being introduced by the NSE over the next 2 years. I've just joined the Council of the Nigerian Stock Exchange, and I think one of the very important things that we're going to talk about at the Council for the next 3 years is how to ensure that we bring in a lot of instruments that will make our market deeper, and obviously that will create the avenue for offshore investors to invest in the market.
Thank you. Thank you.
Kaida, I just want to take up your point there on technology. The flow at the moment in the Nigerian Stock Exchange, yes, correct me if I'm wrong, on a daily basis, we're at about $100 million or thereabouts.
Thereabouts, yeah.
For that level of flow right now, technology isn't really important. You could use technology that's 15 years old and you'd be able to manage that level of capacity coming through a pipe. Yeah. It's less of an issue. I think the issues that we're facing in terms of the development and the size of the African markets is much, much more fundamental. Let me give you an example. For example, we are working very closely with the Casablanca Stock Exchange. One of the biggest issues that they had, Casablanca, by the way, fell from MSCI emerging markets into frontier markets. And one of the liquidity issues they have right now, and one of the issues that investors say they have, is that there is a fear of market risk based on a potential for market manipulation, because the entire Casablanca exchange is serviced by 15 brokers. There are 15 brokers only that are managing all of the orders coming into that specific market, and it's creating, to a certain extent, a fear that these people are colluding together and there's a club. That's just one particular aspect. Yeah. So I think you encapsulated this in your presentation about trust and about creating the right type of underpinning environment for investors. Okay. Is there anything that NSE is specifically doing on that front as well? Because I think that would be quite an interesting.
Okay. Let me ask the questions. Okay. I think that what I want to do is we're just running out of time, and I want to open this up for questions. I have one question for you, though, Ibukun, before Coyote responds. Coyote's success in Nigeria means you will go out of business in London Stock Exchange from attracting companies from Nigeria. True or false?
Thank you, William.
I don't want to put you on the spot.
Well, we don't believe that will happen.
Okay.
I think there is a perfectly deep set of reasons why that won't happen. And to answer it very quickly, the work that has been done, for example, on the dual listing opportunity was encapsulated by the Seplat deal is a very, very important factor to mention there. There is the creation of the right market infrastructures to ensure that you have the right symbiosis of investors who will come from the local market and from international markets to create the best possible experience for the issuer. Today, even though Seplat raised about 70% of its capital on the London Stock Exchange, today there is more trading on the Nigerian Stock Exchange, and that is testament to the fact that there is a unique clearing and settlement system that permits that. So I think we'll grow together is the answer.
Okay. No, that's a great answer. That's a great answer. I didn't want to put you on the spot. Coyote, just bear with me a little bit.
Can I take that quickly?
Okay. All right, you've got 30 seconds.
Yes, what you're saying really, two things, governance and transparency, and I agree that that's very key. And I think if you look at what has happened in Nigeria as an example, and I believe a similar thing is happening in Ghana, there's been growth as you had better governance environment. You've always seen that there's a positive correlation with growth in the market. So it's very, very key. And we've seen that happening in Nigeria. It's not just an NSE-led issue. It's actually led by the NSE and the SEC, which is the regulator of the market. So that has helped a great deal. Technology has helped too. And of course, I don't know if you're aware that very soon we will be introducing a regime whereby people from the US can also access the Nigerian Stock Exchange from the UK without going through a local broker, in which case technology will also help us to grow the value of trade. Today, many times people are just not sure of what they're doing. So it's important that we amplify that. So I agree. Governance is very important. Transparency is important. That will help the market.
Thank you. Thank you, Coyote. We've got about 6 minutes left, and I want to open it up for questions. Please, can we have a microphone in the front for the Honorable Minister? We'll take one round of questions, and then I'll go back to the panelists to answer them.
Yeah. Thank you very much, Moderator. Really, this is one of the most interesting discussions. And I thank you personally for the questions you're asking, which are the right questions. I have one big problem as a policymaker, and I want your help. I want the help of the experts here. You mentioned that we cannot develop without developing the financial sector. And Jingdong said, actually, capital market is not a luxury, which is very, very important. Now, I want you to look at me as a policymaker, whereby from the country I come from, Rwanda, the only big source of money for the private sector, which we need badly because government alone can never sustain the development that we need. We need the private sector way beyond the government money. For them to get money, they are getting only money from the banking system, which is traditional and known. But the banking system are also dependent on the deposits and money borrowed from outside. Combining the two makes it very expensive. The only thing that would save us would be the capital market that would raise more resources beyond the deposits in our own countries that would bring in money from outside. The government is also reaching a limit. We borrow concessionally from international financial institutions. We borrow non-concessionally, but also we go beyond that and go to the market to borrow using the Eurobond. At the same time, you find, how do we develop? What's wrong? You mentioned that it's like intellectuals talking to intellectuals. But here, I want you to see the rural people, the ordinary people in a country. Do they understand what you're talking about? The kind of, when you talk about governance, infrastructure, companies listed, product diversity, and so many things, would the people in my rural area understand what you're talking about? What I'm saying is, what do we need to do in our own countries on the African continent to make sure that we are all aware that this is the way to go? That would be a big step. Then number two, how do we go through the complexity of what needs to be done at each country level so that at least we all believe we are going forward. In other words, you are way ahead of the average African ordinary people because you are there, you understand, you are comparing global markets, but an ordinary people in Africa, the government, starting from the politicians all the way down, do they believe what you are believing? What do we need to do to change the African environment, to make sure we are at the same level, we are speaking the same language? The rest is the technicalities which you need to fix. The infrastructure, the governance, the rules of the game, the diversity of the products, and the rest of it. Please, I would be happy to get an answer for that.
Thank you, Honorable Minister. Let's take 2 more questions very quickly, and then we'll have the panel answer that very pertinent question. Any other questions, or shall I go back to the panel? Right, we'll just go back to the panel quickly. Is there one? Okay. Yeah. All right, there's one in here.
Thank you. Hi, my name is Paul Wallace. I'm from Bloomberg News, and I just wanted to ask the panelists if they thought that governments in Africa should use legislation to force companies to list. Let's take Nigeria, for example. People always say the NSC doesn't mirror the makeup of the Nigerian economy. You've got 4 mobile phone companies that have something like 110 million subscribers, but none of them are listed. None of them look like they're likely to list anytime soon. You've got very few upstream oil companies listed in Nigeria, which was one of the reasons there was so much excitement about Seplat. And the companies like this, I just wonder whether people thought the governments could help out maybe by doing something like making licenses in certain sectors dependent on the holders being listed on local exchanges. Thank you.
Thank you. Thank you very much. Panelists, I think, Jingdong, I'll give you the question that the minister asked just because, you've got, quite a lot of experience across many markets. This issue of complexity, I've certainly experienced it in my interaction with governments, many governments, even at the level of policymakers, Honorable Minister. It's not just, in the village and amongst ordinary people. Even policymakers very often struggle with the complex terms and concepts that are involved in developing, this whole area of financial markets. Jingdong, why don't you have a crack at that?
So, Honorable Minister, I think within 10 seconds, it's very hard, but let me put it this way. China was an agrarian society 35 years ago. And last time I was in China, my mother was giving me stock tips. That's the change there is. So I think there is a process we have to go through, but I think we'll get there. Government's job is really to provide that encouraging, transparent, open environment, build basic infrastructure, and hopefully a virtuous cycle will happen. In answering your question, I don't think government should force anybody to do it, but once you have an environment there, I think good things will happen.
Thank you.
Okay.
Thank you. Coyote,
did you? That, Honorable Minister, the answer to your question is investor education. There needs to be more of that across Africa. And clinics have been held in so many countries that I know of. Incidentally, some of those clinics were actually sponsored by international organizations. I think Citi sponsored one. I think JP Morgan sponsored one in Nigeria, which is essentially to look at investors and educate them about the market. It's very important so as to also avoid a situation where people lose money. Because the day your driver comes to give you stock tips, as mine did about 6 years ago, I knew the game was up. And the poor man, he lost a lot of money because he didn't know what he was doing. So we need to do that. Paul, yes, I agree with you that we need to deepen the market. One of the ways is through bringing those companies, the telecom companies and the power companies to the market. But I do not think we should force people, particularly for telecom companies. They have the contracts existing. What we have advised government to do is to look at putting an environment in place that will encourage them to come and list. In Nigeria, a lot of work is being done in that direction. For the power companies, because I serve in the National Council on Privatization, I can tell you authoritatively that the contracts that were written had that clause in it, that after 5 years, the power companies must list a proportion of their shares in the market. So it's not going to be by force, but it's contracts they've signed. And I think that should be encouraged across African countries.
Thank you, Keode. Miguel, closing comments, 30 seconds?
Yes, on Paul's question, I think privatization is part of the answer. If you look at Southern Europe or Latin America, the capital markets only really developed when you brought the large incumbent, i.e. power companies, telecom companies, banks, those are the companies that will bring size to the market and liquidity.
Thank you, thank you. Ibukun, closing comments?
Honourable Minister, just on your point, I think it's going to be very difficult. It's a very big gap to bridge between the understanding of a rural member or somebody in the rural parts of Rwanda to understand some of the complexities that are going on. But it really screams out for creating more collaborative, cooperative type of investment opportunities for those individuals, giving them some protection and shielding them from, shall we say, the challenges of the markets. I think, Paul, just to answer Paul's question as well very quickly, government should really focus on governing rather than forcing listings, I think. But ultimately, agreeing with Miguel's comments, I think ultimately the privatization and the Bureau for Public Enterprise has a number of key listing possibilities that they can bring to the market. They should focus, I think, on making sure that that stream goes through.
Thank you. Thank you very much. In my own closing comments, obviously we've run out of time. There were a number of questions in my mind, which I'm just going to, open up to the audience and leave them with you and all the panelists. You can discuss them at the break. Obviously, in terms of building a financial infrastructure, capital markets, in terms of, stock exchanges, regulation, is just, one building block. There are other building blocks, collateral registries, data reporting, so that lenders can make informed decisions. These are things that are, very, very still in their nascent stages in many African markets. What do we do about those to create those and to have them going? The second question we didn't discuss was something I think that Jingdong touched on. We know that 70% of all businesses across Africa are either informal or SMEs. Many of them do not qualify to go onto stock exchanges, and they certainly don't qualify to go to a London Stock Exchange. So the question is, what is happening to this 70%? And considering that we've talked about the financial infrastructure still being inadequate to service them. So again, big part of all our businesses across Africa still underserved by our capital markets, and these are the challenges that we have. I thank you all as an audience. I thank you, panel. Please give them an applause. Thank you very much. I hand it back to you.